Great to see you, Hans. Thank you so much for being here with us today.
Thank you for having me.
How are you finding the event?
Fantastic.
Yeah.
I literally arrived like 2 hours ago.
Okay, so is this your first talk?
This is my first talk today.
Okay, are you doing more talks?
There's one more, a fireside chat.
Okay, what's that about?
AI.
Okay.
The iPhone moment.
Yeah, okay. A lot of our talks are about AI, but I guess they have to be, right?
Correct. This is the hot topic today.
Yeah, exactly. Okay, well, thanks for being with us here today, Hans. I explained to our audience that I'll get the ball rolling. And then anybody who has any questions, just raise your hand. And we've two excellent volunteers here. He'll bring you over the mic. I'll kick off. How has this year been for you as an active fintech investor? What's the climate like at the moment?
Right. At the beginning of the year, I did an interview, and the tagline ends up being that I don't mind seeing down rounds. So that was the beginning of this year. We do see some of that, but more importantly, we also see a lot of companies growing this year. I have several portfolio companies that double or triple first half this year, and some could even do 4 or 5x for the rest of the year. And not a lot of them don't have to burn a lot of money to do that because they have product market fit. One example, in a high interest rate environment, if you can issue a securitized credit card that's leveraging off your mortgage loan, because securitized, interest rate will be lower. So they look at you, in 16 minutes, they can figure out if you have a mortgage loan on your asset. Let's say it's 30% down payment, 70% financed by loan from bank. They just add another 5% of a loan on top. So they're not taking materially more risk. They understand that the mortgage loan is in a good position. They verify your income, and then they can give you approval in 16 minutes. Even for me to get a mortgage loan, it'll take at least a month, if not 2 months. Anyone with a mortgage loan with good income can get that credit card approved in 16 minutes. So having something like that that's lower than a market rate, because securitized, allows them to grow extremely fast.
How do startups stay relevant in such a climate like this?
It's not easy. We have about 150 portfolio in North America. I would say 50% of them have cash runway of 3 years or more. Another 25% have cash runway of 24 months or more. And so you need to be around to be relevant. So first of all, managing cash carefully. And then secondly, like I said earlier, companies that can find a true product market fit can still grow a lot during this time period. So learn to be efficient and find the pain point that's relevant today and to be solved and do that efficiently is the most sure way to build something lasting. And thirdly, because we have been investing since 2000, we've gone through several cycles. So we know that there will be great companies that will emerge throughout the cycle.
Thanks, Hans. I can keep going, guys. Does anyone have any questions so far? Yeah, over here. Thank you.
Sure. Yeah, so just a quick question. I think you've been in venture capital for such a long time. I'm like 3 years into the industry. What's the most important part about your job, the most difficult part? Is it raising capital, investing capital, or helping portfolio companies scale? Because the reason I ask that question is I want to align my career to this industry, so I want to make sure that I'm setting myself right on the right stage. Right. So again,
great question. I would say that when you're first starting, raising capital, of course, seems the hardest. And the second one, to me, since I've been in the industry for a while, is actually exit. Because when you invest early, you have a number of interesting portfolio company. You think you're doing well, your company's doing well. But after they go public, it's a very different ballgame. And when do you exit? It's almost like you're at a casino table. Things are looking good. You want to go long. The market is hot. And then next thing you know, the market corrects, and a lot of the value of the chips came down dramatically. So how to exit is not easy. So that's, to me, the second hardest. The third hardest, depending on how big your shop is less about you having conviction on the deal, but convincing your partners who are skeptical of the deal to believe that this is the right deal to do. And you need to take their input to help you make the best decision, but you're also the closest to the action. So you also need to have that distance to listen, but also have that conviction to say, yes, I hear all of you, and I incorporate your feedback into what I do with the company afterwards, but this is still the deal I think makes sense for us. That's probably the third hardest.
I think on the exit part, is every firm has different strategies, right? Is that the thing? So again, selling, I don't know, portion of it, keeping runners as we call it, is that something like you see play out a lot is just like get it out of the way, get it out, get the return going?
I've come through a few cycles. I would say I would sell some even before IPO. Just take 10% off the table. If it's a hot deal, people want it, why not take 10, 15% off, 20% off the table first? And then once you go public, you have to go through 6 months of lockup. So after lockup, you can sell some as well, but don't sell all if you believe in the company. So we tend to do in stages. Each quarter post lockup, we have a rule of about 5 to 20% of our position every quarter. So if you like a company, you can do 5% for a while, and you can be in the company for another 4 years post lockup. If and that's more than enough time. And if you feel like, hey, let's be safe, you can exit within a year post lockup. So you should have some flexibility. Even then, when the market corrects like it did from first half of 2022 after February in Europe, the market changed very quickly. So even with that method, you're not going to get them all. But at least you have a way to kind of space it out.
Cool. Thanks, Hans. On that, speaking of taking 10, 15% off the table, before we get on the table, what qualities or criteria do you look for when selecting early stage startups to invest in, and how do you identify their potential for growth and success?
I usually look for product market fit or product founder fit. Best example for product kind of market fit would be Airbnb. I remember us talking to Brian Chesky very early on, and they did not meet their numbers from Series B to Series C. And that's before I joined GGV. My colleagues who met them said, it seems hard to invest in companies that kind of miss their thing and want a high valuation. But we keep on talking to them. When they're ready to expand to Asia, we want to be helpful and thought that they could make a big difference. So we end up investing in a later stage, in the growth stage, back in 2015, and help them to scale. And during COVID, we were probably one of the few that stood behind them and get onto a public forum like this and said that, travel is down, but Airbnb can be more nimble. People want a staycation. They want to drive 150, 200 miles from their home. And when that happens, Airbnb can get more inventory in middle of nowhere faster than hotels can put up new hotels. So we thought they had a chance to compete. And the team just, outperformed that any one of us thought was possible. They did a great job. So that's a good example of where you kind of have to know the market really well and identify that the founder is the right fit for that. And then, even when the market is down, believe in your model, believe in the team to see if they have a chance to make that work. The other one is the founder product fit. And for that, I feel like a good example for that would be Max Levchin, initially with PayPal, now with the firm. When he was doing Slide, which is web gaming, didn't thought I was kind of misplaced. But anything that's fintech related, he's very suitable for that. What is for the right market with the right product? He's such a strong product guy. He has a great sense of what kind of product is needed at the time. Even if a firm's kind of down today with buy now, pay later, I have a lot of confidence in him to come with something new over time.
Thanks, Hans. Does anybody in the audience have a question? Yeah, over here, please.
Okay. Hello, my name is Rodrigo. I'm from Brazil, and curious to know you have some investments in Latin American startups, Clara, IdeaWow, Logi, to name a few. So I would love to know your view about, the market conditions right now, because Latin America, it's subject to a lot of externalities, and it's a very challenging landscape. On the other hand, there's lots of room for innovation, right?
Great question. As you know, we invest a lot in the U.S. We also invest in emerging markets. In emerging markets, we did quite a bit in China, quite a bit in Southeast Asia. And Latin, Israel, and India were some of the new markets we picked up over the last 4 or 5 years. And for Latin, it's such a sizable population and a growing middle class. And you look at the GDP per capita, it has bigger economy in terms of GDP than Southeast Asia. And it's only 2 languages, Portuguese and Spanish. Yes, there's cultural barrier between the two, for sure, and there's some problems to overcome. But still, you have 2 distinct markets within that region already. And then we're just seeing the quality of teams have gone up a lot over the last 5 years. And as you know, in 2020 and 2021, the market was very hot. So everybody piled in. A lot of consumer teams on Sun Hill Road, where I am, we see a lot of people investing in companies in Latam. Trying to come around, every IC become a little more conservative. People want to preserve cash. They only invest in the U.S. They don't invest in emerging markets much out of Sun Hill Road. So you see the level of activity come down dramatically. At the same time, there's still companies, some of the companies you mentioned, that are continuing to grow and become more efficient in the process. We've seen this happen in many other emerging markets, whether it's China or Southeast Asia. You just have to be patient to get through it. The companies that can survive through this period, kind of how Nubank first started, they will get funded later. So having that kind of patience, when things are very hot, you don't get carried away. When things are bad, you also stay vigilant and stay disciplined and stay strategic and stay with the companies that make sense. And you have your target list, you work with them. The dynamics of the market is actually quite good. The only risk we worry about is the Forex risk. But now it's more toward, near the bottom of that anyway. It's actually the right entry point to do it. The biggest challenge is that LPs lost a lot of money in Latam, in India for that matter, for US LPs. So they're much more skeptical. So you need a few new banks of the world to emerge and go public and do well to attract more attention in that region. But you see how Stone has done. You see some of the e-commerce players have done. Fintech players have gone public. I still think that Latam is a great market to invest. So got to stay with it.
Hans, you kind of touched on it there, but you guys obviously have presence both in China and the United States. What are some of the key differences and some of the similarities you've observed in the startup ecosystems of these two countries, and how do these differences impact investment strategies?
Yeah. I remember 15 years ago when I first start looking at investments in China from U.S. A lot of people say, well, China copies everything. China has a firewall, a Chinese wall. Therefore, great companies cannot get inside. And but the product is just it's not a lot of innovations. And fast forward to now, when you see like Shein and Temu and TikTok doing well in North America, that perception has changed. Today, you don't see a lot of products from Latam or India or Southeast Asia, or even Europe for that matter, on the consumer side in the U.S., in North America. What I think is that over time, the best teams that are hungry and thoughtful will emerge, and they end up being able to expand beyond. So seeing these companies that compete against each other, learn from one another, is a great thing. We used to do a track of take our U.S. founders to go to China to see what's like. We don't do that anymore, given the geopolitical tension. But it's a shame because a lot of learnings and competing makes everyone better.
Thank you very much. Any questions from the audience? Oh yeah, perfect. It should be on. It should be on now. You're okay.
In venture in China and the US, and I have a question. Like right now, I think everyone's talking about AIGC, generative AI. And then, so for emerging managers like me, if I think, it is one of the biggest trends going forward, like what are some suggestions on kind of, investing in the next generation of AI companies? Like what are some good qualities, or how would you evaluate AI companies? Are they going to be similar to what you have done with the consumer that GGV has, a lot of experience in? And also specifically for GGV right now, what are some sectors of AIGC you guys are heavily investing your time and resources in kind of learning or investing?
That's a great question that someone will ask me at the next session I'm doing.
Okay.
So I'm not going to give that away too much, but I will say that we do look at the 3 layers in AI. That's foundational layer, like the hardware and LLM. But over there, it's more big players playing in that market. The second layer is the middleware layer, kind of a lot of tools, dev tools that are being built. A lot of them through the API model rather than the SaaS model. And that's increasingly interesting. The SaaS model probably follows more of an open source software model. The application layer is where some of the consumer background I have become more relevant. So application by vertical, by industry, applying AI, and I'll share more of examples of that in the next session. But we're seeing that happening on fintech, on retail, e-commerce, construction, real estate, and S&P tech in general. So, and customer service as well. So there's a lot of application type of things that one can invest. So the third layer is probably where most VCs whether it's emerging or someone who's been doing it a long time, will invest. The middle layer, we have a dedicated team that look at infrastructure investments. So that's a layer that they've done a lot of open source software in the cloud era. They've done a lot of investments in the API first kind of startup, and that's something that we think will be dramatically interesting over the next 10 years. Regardless, this is probably the biggest trend we'll see in for the next 10, 20 years. So this is where everyone is spending time.
Thanks, Hans. Yeah, we have one over here, please.
Work? Oh, hi. My name is Jing Jing. I'm the founder of BU. We're an Asian influencer marketing platform. My question to you is how do startups like us pitch to GGV Capital? What's the best way to pitch our product?
You can send your deck to marketing@ggvc.com, and I'll definitely get it.
Cool. Thanks, Han. You spoke about the competitive edge that startups need to have, AI being one of them. But the venture capital landscape has become increasingly competitive as well. How does GGV Capital differentiate itself from other VC firms, and what value add do you provide the companies you invest in beyond capital?
I believe that all battles are won before they're ever fought. Those of you who care about history know who that quote comes from. And so when I joined GGV from a previous VC firm in 2013, I like the fact that GGV is kind of global from day one, started in Singapore and Silicon Valley. And then GGV was one of the early investors in China before it becomes a thing to do, and was an early investor in Alibaba. And so having that touch point in 3 geographies was something that attracted me in 2013, because the world may see more geopolitical tension. You also see more redundancy. Everybody is setting up outside of China, where China becomes more self-sufficient. So at the minimum, you needed 2 locations. And then in the emerging markets outside of China, whether it's Southeast Asia, India, or LATAM, is becoming more and more popular. So having presence in emerging markets that's different from in Western European markets or North America is also increasingly important. So having these clusters growing up, if you have that global data points, becomes very powerful. So one of the things that we do that other investors or VC or founders look at to us is having global data points of the same industry in multiple geographies. The second thing, I have to give credit to our platform team. We've been building them since 2016, led by Jen Holmstrom, who's in the audience, and she built a team in North America that covers BD, marketing, talent recruiting, people, cultural management. There's a lot of founders who love sending their team members, not just the founders, not just C-level suite officers, but also VPs and directors to her Founders and Leaders program. So that kind of hands-on, being helpful, providing tools for a portfolio company to use and manage and grow is something that we get a lot of positive feedback. Every deal we want to win, we just have to send founders to be our references, and 8 out of 10 times we'll get the deal that we want, because the founders that we have helped before become the best reference points for us. And then thirdly, we are organized by industry groups. So whether it's consumer, fintech, enterprise infrastructure, cybersecurity, data. There are different teams within GGV that become an expert in that topic, so we can be relevant to the founders we work with.
Thanks, Hans. Thank you for that. Any other questions from the audience? I think we've time for one. We'll take 2 more. One here and one at the back. Thanks, guys.
Hey, Hans. Thanks for your time. My question is, how do you think about valuations for early stage startups? And the reason I ask is, seems like last year crypto was worth $1 billion. Today AI is worth $1 billion. So it seems like the valuation is tilting more towards what the macroeconomic condition is and what's getting more heat, rather than the intrinsic value of a company itself. So when you're evaluating startups at an early stage, what are some of the key principles and fundamentals that you look for in their valuation?
Yeah. A lot of LPs that we work with ask us that question for obvious reasons, and it's a fair question. I think that since so many unicorns have been born since 2015, people anticipate that investment they make have a good chance to become a unicorn, or the sector will allow more unicorns. So in anticipation of a unicorn coming, they go back and say, this is the round coming in, by the time it becomes a unicorn, maybe a few rounds later, what's the right jump along the way that I'll pay for? So there's some of that going on for sure. Having said that, the best companies are still the ones that are fixing big problems, big pain points that over time you can see how they can monetize. Over time they can see how they can be useful. Over time, why certain customers who are representative of a much larger TAM will want to pay for that. And so you can still look at a lot of investments these days, even for AI, using more of a SaaS or first API first kind of approach that we do in cloud very much. So you do see, people care about how soon are you to monetization and what kind of ARR, what MMR run rate will you have, and do you have a product market fit? And do you have people willing to pay for it today? And what is that AOV? And is that expanding? And how is the retention, logo retention, and dollar retention? So those are the things that you can still analyze and figure out. It's not a science; it's still an art. And I can tell you that almost every deal is expensive. The ones that work out looks cheap in hindsight. The ones that are expensive, it's like, what the hell are you doing? So they are going to be expensive. So you got to pick and choose carefully the ones that can end up being a much bigger outcome.
Thank you so much.
Thanks, Hans. One more.
Thank you. So I'm Makino from Japan. So I have two questions. And so do you have any changing of the investment criteria during the market crisis? And the second point, and so what do you think about and the market is just recover, the way the market recover?
Yeah. Well, the second question is the billion-dollar question that everyone wants to know, and no one has a crystal ball. I think that our approach from 2021 to say now, I don't think the approach has changed that much, but now we have more time to do due diligence. We have more time to track companies. We have more time to choose. Whereas in 2021, every company that's interesting is getting like 10, 20 term sheets. So it becomes very harder to spend time with them before you invest. And in terms of where we are, interest rate may go up a little bit more before they come down. We feel that there's a risk that the worst is yet to come before it gets better. So we tell our founders, embrace for turnaround like in 2025. Think of the worst case scenario and kind of manage it so that you can have upside surprises. If we're wrong, things are not as bad, you miss a year of growth. But if we are right, we're right and you're wrong, you grow too fast, you run out of cash, they may not be a company in 18 months. So the cost of a mistake on being conservative is low. Being aggressive is high. So you might as well manage for the downside, become more efficient in the process, and let the upside surprises, give you something to cheer about.
Hans, thank you so much. Can we put it together for Hans, everybody? Thank you so much.
Thank you for having me.
To continue the investor conversations, guys, we have another special guest coming up, so please stay where you are.